All right, folks, welcome back. First Lady Harmonic here, talking about entries and exits. This is, of course, very key and very vital in anybody's trading, no matter what method you're trading, because you need to know how to enter and how to exit. And since the harmonics is the method that you've chosen to learn, how is it that we enter or exit the market? Like I said, harmonics always gives you a directional bias and also gives you an opportunity to know when and where to exit the trade, the market rather. So what I have here is I'm just using a DXY right now. Again, I'm always going to try to be as simple and short as possible because I believe that when you keep things simple, you have a better opportunity of learning, as well as this video you can go over and over again. Like I said in the beginning of the page, the entries and exit page, there's two methods in which I use to enter and exit the market based off of a harmonic pattern. So usually we have our D point here, right? So let's just talk about the sell limit, so to speak. So we have our D point at this point, which would be an 886. So let's just mark that up right now at the 886, right? Let's see what my ABA would be to create either a PRZ zone. There we go. So technically, this would be my PRZ zone. Now, what you can do as far as a sell limit is concerned, at the 886 here, you can also just put a sell limit. And after you put the sell limit, the 618 area here is actually the whole PRZ zone. Sometimes what I do like to do is wait for price to completely hit the 886 and the PRZ zone, but as you can see in this particular pattern, it does not. Once again, understand that these are just zones or areas. Things are not exact all the time, if not 100% of the time. So you could put a sell limit at the 618 if you want to, but in this particular case, you would have missed the trade. You have missed your entry. Sometimes I put a sell limit in between, in the middle of the zone itself. So that way I try to catch it if it even hits, if it hits 886 or hits the 618. In this particular case, as you'll see, I would have missed the trade. So what I normally do when I'm doing sell limits is I will set my sell limit at the decompletion point, whether it's a crab, whether it's a shark, or whatever. In this particular case, this is a bearish bat. My D is an 886, and so therefore my sell limit would be at the 886. Now, the Scott-Carney's rules for your stop loss would be above the X leg. And so what you can do, it depends on what your risk management is. What you can do is you can measure out from X to A, and you'll see that at 100%, and then there's 113. You can then put your stop loss at 113. Let's just mark that red. Or you can put it in the middle and so forth. It doesn't make a difference. It really depends on what your risk management is. In this case, it is, let's see, 55 pips. If you don't want to have the 55 pip stop loss, that's up to you. This is an H4 time frame, so 55 pips is really not a lot of pippage. And so technically, it's 55 pips from the X, but it's actually more because if you have your sell limit here, you're actually looking at 104 pips from your entry point. So if you want, you can bring it down some, but just remember you have the 618 here, and you know sometimes price does overshoot, so to speak, so it could possibly go above the X and then come back down. And so I personally would recommend the 113. And the reason why, one of the best reasons why I would say the 113 is because at this point, at 104 pips, you probably are saying, you know, that's a lot of pips, that's a large stop loss, which it really is for H4 time frame. But what it's also going to do is going to kind of force you to manage your risk, because at this level here, depending on what you have in your account and what you're placing for the trade, you can blow your account. So now you have to really think about how much you really want to risk in this game right here. And so it kind of forces you, help me for one, it kind of forced me to stay alert, be very aware, and use the proper risk management. So that way, even if I did lose, I'm not afraid, so to speak. And I can tell you this, if you're very concerned about your stop loss getting hit, it means that you're over leveraging. Because if you can trade, and whether your stop loss gets hit and you're fine about it, you're doing good with your risk management. But if you have to constantly look at your chart and wonder what's going on, you've over leveraged. Trust me, you'll know. If you don't know how to manage your risk, what risk management is, and how can I say, how much you should be placing per trade, you'll know that you've over leveraged if your emotions are involved, if you're fearful of getting stopped out, because you know either you're going to blow your account or you're going to lose a large sum of money in your account. That's when you know you've got too much stake in the game that you really can't afford. Okay, so that's the basics of doing a sell limit from a harmonic pattern. What I like about this is that you can kind of set it and just leave. You have your good risk management in place. You have a sell limit in place. You can just pretty much just kind of walk away from it, and you don't have to manage charts. Now, using price action, that's something different, because you have to be aware of the candlesticks and the candlestick patterns that's giving you the identification, is giving you the clue, the signal, the ringing of the bell, whatever you want to call it, that it's time to enter into the market. So what I also wanted to bring up is also, once your harmonic has reached its completion, as you can see, price has this big bullish candle here. The next candle should be some type of rejection, which is what we see here, a nice bearish candle. So it kind of verifies or validates the completion of the pattern itself. Sometimes if you have a decompletion and then you have a nice strong bullish candle, I would definitely say that's something for you to be on the lookout for, because it could mean an invalidation of your harmonic. But being that in this particular case, the 1618 is above, if we had gotten another strong bullish candle and it went a little bit over the 1618, I would not have been alarmed. I would have been waiting for the next candle to show some type of rejection, and that means that we have to be some type of bearish indication that this pattern has completed. But if we had gotten another bullish candle, it would have invalidated this whole situation here, and then you want to be alert to getting out. And what you're looking for is, in this particular situation, your X. You don't want price to come and close above the X. And when I say that, it's because that definitely invalidates your harmonic pattern. I don't want to get too much into that, because this is about entries and exits, but at the same time, this is an indication of when you should get out of the market. If you have a sell limit and you see what price is doing and it has come up and is now closing above the X, you now probably need to get out of the market. Like I said, always look to see, because sometimes the market will trick you. It will come above the X, and then the next candle will be a bearish candle and come back down, just showing that this area here is just being tested. And another trick you can learn in reference to that is you can just go to the next time frame up, which would be the daily, and most likely you'll see wicks. And if the daily closes with wicks but below the X, it still validates this pattern. It's very key, because understanding how the time frames correlate to one another, you won't get psyched out. So again, I'm going to repeat that if price does come above the X, and then you get some kind of bearish candles or maybe a reversal pattern and so forth, and you're wondering, well, it's still closed above the X and so forth, it invalidated. Go to the daily time frame and see if price closed actually below the X. Most likely it would have. Sometimes it doesn't. Depending, if you have wicks, it still makes this pattern valid. So just remember that. Okay? So this is pretty much how, it's the simple way of how I sometimes enter the market using sell limits or buy limits. In this particular case, it would be a sell limit because this is a bearish bat, meaning that the D, after the D completion, price should fall, and that's what makes this a bearish bat. Okay? Let's just get rid of this, because now we're going to talk about something else, and it's another way of entering the market, and it's going to be based off of what? Price action, which price action is king. So what is price action? Price action is your ability to read the charts. You don't have to have any type of indicators, moving averages, anything. You can be able to trade completely naked if you really understand price action. But that's a whole different training, so to speak. But you can use price action in harmony with harmonics, or you use harmonics more like in harmony with price action, because price action really is the king of trading. Once you understand what price action is, you'll be able to see what's going on in the chart and what you should do in responding to the reaction of what price is doing. So in this particular case, what is it that we see? We have a decompletion here, right? So we have the bullish, then we have a bearish candle, which this particular here, this pattern here is a reversal pattern. So this will give you some kind of indication that price is likely, highly likely, going to reverse. But then you may wonder, well, you're starting to see some type of, you know, little candles here, little dojis and spinning tops and things like that. Then you have another bullish candle over here as well. Let me just see if I can highlight this. I don't want to do that. I want to do a box. Let's make the box yellow. Okay, so this is a reversal pattern. This is a reversal pattern. Right here. I'm going to show you something interesting in reference to that. This is also a double top and the M formation. Remember I told you M's and W's? There are M's and W's all over the place in the market. Small, large, medium. So what we have here is an M. You understand what that is? So you have the double top. So this would be kind of tricky because you're looking at it and you're saying, well, I have my reversal pattern, my bearish reversal pattern. And if you don't understand what the reversal patterns are, I'm going to have some charts that's going to show some nice reversal patterns, what they are. What you're mainly looking for, and listen closely, you're mainly looking for engulfing candles. In this particular case, you're looking for a bearish engulfing candle. You're looking for what we call, I call them railroad tracks. This would be a railroad track. This would be a railroad track. You're looking for evening stars or morning stars. In a bearish situation, you're looking for an evening star. I'm going to see if I can find one for you. Matter of fact, here is an evening star right here. These are reversal patterns. This is a signal that the market is giving you that it is going to reverse. This is a evening star, and an evening star consists of 3 candles. Sometimes the evening star is shorter than the bullish. Sometimes it's the same size. Sometimes it engulfs it. In both of these situations, it engulfs it. So this is a very strong indication that it is going to reverse. And again, what we have here is another M formation, a double top. Okay? So these are 1, 2, 3 reversal patterns that you want to make sure you look for. And these are indication again that price is going to reverse. Now sometimes you see these patterns and it kind of tricks you out and so forth. Don't be afraid. Sometimes they're not all winners, they're not all losers. 9 times out of 10, I'm going to be conservative and say 7 to 8 times out of 10, if you're in the right area, these are definitely highly reliable reversal patterns. And being that this is a completion of a harmonic, and you see this pattern, both of these patterns here, you can have confidence. There's no reason why you shouldn't be taking a trade. And one other reason is understanding price action. You're looking at this situation right here. Let's go like right here. Let's change this to black. So now this level of support has been broken by this engulfing candle. So if you wanted to wait for this engulfing candle to close, this would, all this here is a nice retest, but then when you have to confirm it's about to go down again, you have a railroad track. So there, this would be your signal, and your entry would be, some people enter at the low part of the engulfing, or some people enter right when it closes right there. That's completely up to you. But what you want to look for is the signals, okay? So you see this and you wonder, this huge candle, you've missed the move. Understand also, when you see huge candles, those are called inducement candles sometimes. And what happens is they induce you to get into a sell. And what they do, they pull back. But then it continued to drop, okay? So that is one area, the main area of understanding when to get into the market, by using what is called price action. In these type of scenarios, you every 4 hours you would be looking at the charts, waiting for the signal. So here goes your D. Your D has made its completion. Okay, you have to wait 4 hours to see this right here, this pattern. And let's say you get in. Where would you place your stop loss? I would place my stop loss again above the X, or let's say I try to have like a, depending on the time frame I'm working with, I try to have between a 30 and a 60 pip stop loss, again depending on this time frame. This is a 4-hour time frame. I try not to go higher than 50. So if I'm going to enter here, I would have my stop loss like right there. It's 114 pips actually. And so again, what this does is it gives you a greater opportunity to manage your risk, because that's a large stop loss. You want to be able to get into the trade, give the market room to breathe, at the same time be able to walk away and feel comfortable knowing that you are safe in the market. Let's just say that, okay? And so what's going on is that you've seen the situation here. Okay, so you got a little bit of drawdown, you got a little bit of drawdown, so you're waiting 4 hours, 4, 8, 12, 16, 20. So basically a whole nother day before you actually really start to see a major reversal based off of this harmonic pattern. Again, your take profits would be from A to D, right? Scott says you can use the extreme of where price has gone. So say price has actually gone to the 618. You can bring this A to D up completely to where price has extended to, or you can use it at the D level itself, right? And then you're looking for a 382, 61.8. If you understand price action, you can stay in the trade a little bit longer. But your 382 would have been hit from this long engulfing candle. It has retraced back up and has come down to hit my 618. And again, we're looking at another reversal signal as well. This is a chart pattern we're looking at here. Not all chart patterns of this nature, which I'm about to talk to you about, should be traded, but it also is an indication of some type of reversal. And this one particularly is called an inverted head and shoulders. So left shoulder, head, right shoulder. This looks, I'm just going to draw this out with some lines. So you have the right shoulder, you have the head, and you have the left shoulder, and then you have the break. And when this is broken here, your inverted head and shoulders has been activated. But again, usually you'll see that when there's a major reversal in a trend. So not all patterns should be traded, because as you can see, we're still in a downtrend. Price came back up, created a double top, and then continued to fall drastically. So understanding price action, you have to have an extreme amount of focus and paying attention to what's going on to understand what the market is doing. Now I have, this is my 200 EMA, which is a very strong either support or resistance. I have a 50 EMA as well that is a strong support and resistance. So looking at this pattern here, my evening stars, and how a price has closed even below my 200 EMA, it's giving me a nice indication that the trend is going to continue downward. Okay, so that's just price action, real basics of when to enter into the market using price action and what you're looking for. Now, let's say I believe the safest way to trade harmonic, and it takes a little bit more experience, is to trade from the C to the D point. And the reason why I say that is because sometimes price gets to what we have charted out to be a D point, and price continues to go. And it now has either invalidated your harmonic, or either it's a different harmonic. But in order to, let's say, eliminate that possibility, trading from the least to a C to D point would help you. You get a lot of pips out of that. Okay, so how would I do that? So now we have my X, we have my A, we have my B point right here. And you're saying, well, let's use some fibs. Okay, so from A to B, we have a retracement of an 886. Now remember in the fib video that there are certain fib ratios that are highly reactive to price. 38.2, 61.8, 78.6. And I say 88.6 as well because that is a nice harmonic level in which harmonic tends to come to react. And it's usually a level at 86 where price has reached an extreme point in which now it's going to do some type of reaction or reverse, or either do a continuation. Okay, so in this particular case, we have price come down to the 886. We see that right here, right there. I'm going to take off this. I'm going to take off the fibs because I don't like my chart looking so nasty. Okay, so now we've come down. And remember I told you we're looking for some type of engulfing pattern. This pattern right here is called a bullish engulfing pattern. It has completely engulfed its bearish candle before that. That is a reversal signal that buyers have definitely overtaken the market. Something else I like to do is called a bullish variation, meaning that this particular high right here has now been breached. And we can see that clearly that we have this engulfing, then the next candle closes above. And notice this wick right here. So the question would be, where would I place my stop? If I'm going to get in after my bullish engulfing, I'm always going to place my stop between 15 and 20 pips below the low. So here goes my low. And 15, 20 pips, about right here. Again, this is H4, so I would do about 30. 30 is usually my minimum, to be honest with you. Well, let's say you want to use 40, something like that. So my stop would actually be right around here. Again, and the reason why is I'm giving myself room to breathe. I'm also want to look to make sure that price, if it starts to close below my A point here, it could be an invalidation of my harmonic. Could be a different harmonic, of course, because it's going to be extended pattern. But these are the areas that I'm looking for. So once I see that my bullish engulfing has come and has also closed above this bullish variation, meaning this particular high right here, it has breached it, I would enter the trade. You would enter here, I would enter it here. Some people will wait for the close. We have a retest noted by this bearish candle, also closing above my 200. You would enter. You can also enter on this candle here and just ride it out. So that is how I would enter that trade if I'm riding to the C to the D point. Hope this all makes sense. Again, you want to make sure you're looking for reversal patterns. Looking over here, let's say from the B to the C. You have, again, a double top. And it's something that is spotted once you, from doing harmonic so much, you'll be able to understand double tops and double bottoms. But okay, here's a reversal pattern here, some dojis. Then you have a bearish engulfing. So you have a reversal pattern here, a bearish engulfing, large indications that price is likely to reverse downward. Then you have a retest with another reversal pattern here. So you have three giving you good indications. Nothing is breaking the high. So you have rejection from the buyers. You have reversal patterns. There's no reason why you wouldn't take the trade, at least from this point on, and to write it down. So again, price action. You need to pay attention very carefully to the candles. Understand the candle patterns. You're looking for a bearish or bullish engulfing candle. Looking for a morning star or evening star pattern. Understand when you're looking at double tops. Again, let's see my zigzag, what that looks like. This zigzag is not going to show you everything. But look, you see my double top here. They don't have it here. Doesn't have it here. So the zigzag tool can chart out major areas of support and resistance for you as well, as new in one of my previous videos. So like I said, didn't want to keep this long. I don't want to make it complicated. It's very simple. Tell yourself, have the mentality that it's simple. Look for a few things. When you see those few things, take the trade. Understand where your stop loss needs to be. I'm usually above the previous high or below the previous low. On higher time frames, your stop loss will be larger. On lower time frames, you can have a tighter stop loss. It's not a problem. But like I said, I never tell people what proper risk management is. You decide for yourself. Don't risk more than you're willing to lose. If you're into a trade and you're anxious about it, your emotions are involved, you're always checking the charts, you've over leveraged. Harmonics helps you with that because of where your stops should be placed, and sometimes it's a large stop loss for you. I really don't like to do more than 30 to 50, maybe 60 the most. So I'm looking at 100 pip stop loss. To me, it's a very large stop loss. So now I'm concerned about my account. And so now my risk is going to be different. I'm not going to go in there with a 3, 4, 5 standards because that could blow my account if I'm wrong. So what the consistent and most profitable traders are looking at is not how much money can they make, it's how much money are they not willing to lose. So you go in from that perspective, your trading is gonna be different, and you're gonna be more patient. You're gonna wait for these reversal candles. Okay. So if you have any questions, I'm always here. Like I said, I'm not gonna go into all the details. You go to babypips.com. I'm going to upload some charts on what these patterns look like. But engulfing candles, bearish engulfing, bullish engulfing, morning star, evening star. Right? You're looking for double tops. You're looking for double bottoms. Look over here at the first double bottom. You have a nice bullish engulfing candle. You also have price that is now closed above, and I call this a bullish variation. So you have indication that price now is very bullish. The buyers have taken over the market. So understanding that, you want to look for the previous high. You want to look for reversal patterns. I have my 200 EMA. Price is above 200 EMA, giving me another confluence. The price is bullish. And then once we come all the way up, and what you can do in situations like this, I know it's about harmonics, but understanding how to trade a potential harmonic. You see price, again, using your Fibonacci tool, has come up into an area 61.8. It's 61.8. What is it creating? It's creating a double top, showing that it is going back down. So, and though, again, looking at the ratios at the Fibonacci and seeing what price is doing at certain levels, no, it has not actually touched 61.8, but it definitely has gotten close enough, and it has reacted to it. So it has responded to it. Now it has reacted to it. And what you want to do, you always want to respond. You don't want to react, because sometimes, you know, you react hastily. You don't want to do that. So you watch how the market reacts. You watch what it does, and then you respond to its reaction. And that takes discipline and patience, especially on a 4-hour chart, because now you're waiting every 4 hours. And sometimes, and I had to learn this myself, I'm still learning, sometimes you just want to be in a trade, but you want to be in a good, high quality, profitable trade. Or you know that you're waiting for the D point, but you want to get some pips out of it. Then you need to learn to wait for the market to show you its hand. Once it shows you its hand, then you can go ahead and grab some pips. The high time frame, yes, it takes a lot more patience, but with that patience comes a lot more pips. And that's why some people trade the high time frame. The banks, the central banks, the hedge funds, the institutions, they trade on the high time frame, particularly the daily, the weekly, and the monthly, the very high time frames. And so they kind of just place their trade, and they leave it, because they know they have to leave it for days, weeks, and months, and so forth, sometimes even a year or more, to reach a certain point in which they're going. So if you want to learn how to trade from a higher time frame, you actually are going to develop, for one, a better risk management strategy, and you also going to develop patience and discipline. And it's something that a higher time frame, if you're actually working 9 to 5, or you have a very busy lifestyle, you can't sit on the charts, H4 and up is the time frame for you, because if you're working at 9 to 5, you really have to look at the chart twice, 9 a.m. and then 5 p.m. Actually 9 a.m., 1 p.m., and 5 p.m. So it would help you continue to live your life. If you're going below H4, like an H1 and below, you're what's called an intraday trader. And, you know, every hour you're looking at the charts. And it's doing the same things, but just doing it on an hourly basis. And it's really not that much of a difference. You know, sometimes you feel like I need to get in on a lower time frame, but, you know, it's maybe 10, 15 pips difference. So just be careful, just be patient. Remember what I said in this video here, what to look for. I have them highlighted here. They show up all over the charts, as you can see. I'm going to chart some more. I'm going to box some more out here. Okay, you see that? You see also the M here. There's also another reversal pattern here. You have this big engulfing candle here, and then again here. You have this is a morning star pattern here. Also recognize that every time you see a pattern does not necessarily mean that it's a tradable pattern. You may get some pips out of it and so forth, but what you're looking for in trading harmonics, you're looking for the move. It's called the move, which means you're going to get, you know, 50, 60, 70, 80, 100 pips or more from the move. So, you know, if you want to scalp, you see that, you know, okay, you would have got some pips here, really. Let's see how many pips you would have gotten here. Let's say you got in over this, you had a little bit of drawdown. Okay, you would have got your 97 pips. And that's a short. That's not even the move. So that's not bad. Your stop loss would be below the low, of course. And if you're getting enough of that, your stop loss would be about 87, 90 pips. Not bad. But so this would be more like a 1-to-1 ratio. If you wait, the price is here, you can actually move this up a little bit higher, to be honest with you. Once price actually close above, again, this bullish variation above the high. I'm trying to get this nice and big here. above that high right there, maybe even up here, I would say, you'll be safe to move your stop loss up. You don't have to have it so far down. So once you see that, you can move your stop loss up. But then you, of course, you get these pips. You look at this reversal pattern and see what's going on. You see price even closes below here. Now you're looking to sell. So you want to make sure you're getting out of the trade in an appropriate time and fashion. And how would you know when to get out of the trade? You have your patterns here. This is a reversal pattern. You also want to look. You see that this is your bullish candle, but now price has actually engulfed it in a selling situation. Sellers have entered the market itself. They are now in control. So once this candle right here has closed, I would have entered into the market for a sell position. But that's, again, this is a different course which will be loaded up on my site. Price action, it's not yet. I'm working on that. I will be working on that actually. But again, it's simple ways of how to enter and exit the market based off of a harmonic pattern. It's real simple. If you have any questions, please feel free to contact me. Watch this video over and over again. Go to Baby Pips, go to Google, put in reversal patterns, learn the candlestick of patterns, and then you'll be able to not only chart your harmonics, but know how to enter into the market once the harmonic has completed. And once you get a lot more experience, like I said, you'll be able to take this harmonic from a C to D completion. You'll be able to go in for buy, and once it decompletes, you know how to get in for the sell. And that's how you milk the market and just murder charts all day long. Okay, so I'm going to end it here, and hopefully you've gotten some nuggets out of this, and hopefully I was able to enlighten you some way. Okay, talk to you later.